keeps you accountable, and people will share feedback on your product, and it allows you to create connections, allows you to connect to generally smart people. It enables you to get quicker access to advice, mentorship from those you may look up to. And also funding, if you're looking to raise VC money, then you can write automatically. So like building in public, you will share your progress and VCs will reach out to you. And how do I build in public? So you can start announcing it on Twitter or any social media platform. Go at your own pace. And where can I build in public? Anywhere your audience spends time. So you can build in public there. So like tips for building in public. So think of what attractive graph number, or share your small wins. How many signups you got? Your MRR, monthly recurring revenue, and think of who you want to attract while building in public. Share both the good and the bad, share your wins and the losses. More transparency can lead to better result. And now I will talk about why raising money. I will be talking about now startup funding. So like the amount of money needed to take a startup to profitability is usually well beyond the ability to finance a startup is built to grow fast. So like people raise money from VCs, and like high growth companies almost always need to burn capital to sustain their growth prior to achieving profitability. So like venture, now I will be talking about VC round. So venture capital rounds usually takes place in round like Series A, Series B, Series C, and so on to acquisition or IPO. So none of these rounds are required, and sometimes company will start at different point of the journey. So sometimes there are bridge round in between the price seed ABC round. And now I will. So there are different type of startup financing options are available. First is equity. An equity round means setting a valuation for a company and thus a per share price, and then issuing and selling new shares of the company to investor. And second type of financing option is SAFE. So SAFE have become mainstream in the US for early stage startup funding round, but are not as widespread elsewhere. Although this is changing, so it is not widespread in all other countries like in our country, India. SAFE is not uh, mainstream in other countries like India. And third type of startup financing option is convertible note. So like it is similar to SAFE, but it is a loan which has a debt component and maturity date. And fourth is grant and subsidies. So business grant are funded by national, local, and government to support deprived areas to stimulate technologies advanced through research and development, and to make an economy more competitive in a specific sector. And last type of startup financing option is crowdfunding. So crowdfunding, it has become an increasingly popular way for startup to raise capital to finance product development. While it might too easy to launch a crowdfunding campaign, there are strong pros and cons to consider. So it can mean not giving up equity, and it can be a great way to test the market if you are raising money through crowdfunding. And also, what are the cons? So crowdfunding doesn't find investor for you, and a desirable product is not the same as investable business. And the founder of Gumroad, Sai Lavingia, also raised the money through crowdfunding. And so like there are lots of different type of investors. So first is family friend. So like it can help you get idea of the ground, and very few string attached straight angels. So it will account for a big chunk of your seed round, and ticket size vary from 10,000 to 100K dollar. So like what are the benefit of angel is strategic intros, external validation, and it can often follow on. And institutional money. So VC's fund are raising money from limited partners, and they can give back when the startup go on to acquisition, IPO, or a startup is acquired. So usually it is first point of institutional validation, and it is introduction of governance, operation help, and introduction. And corporate VC, it is also one type of investor. So long term view need to define expectation, and the benefit is potential customer and unrivaled industry network. And last type of I discussed is crowdfunding. So it is a great tool for B2 C product, it needs 30 to 40% committed before you launch, and it is a great marketing and community building tool. So now I will discuss about when to raise money. So there is no fixed time; it varies for everyone. Some raise money when the product get traction, and some raise when they want to scale up. So fundraising requires near constant attention for 3 to 6 months. So when founder are ready to tell the story, they can raise money, and usually when you can raise money, you should. And how much money to raise? So founder and CEO raise money in order to hit specific milestone. So in choosing how much to raise, you are trading off several variables, including how much progress that amount of money will purchase credibility with investor and dilution. And your goal should be to raise as much as money as needed to get to your next fundable milestone, which is a preset stage. It will usually be 12-month runaway. And look at the optimal amount to raise in your first round is to decide how many months of operation you want to fund. So understanding your monthly cash burn and map out your company's important timelines and the cash you will realistically require to achieve them. So, conducting background research of venture capital is important. So, first map the investor landscape of relevance to your vertical sector business model. Find all the venture capitalists who are investing in your industry. So, don't pitch it. Most of the founders CEO make this mistake. They pitch their startup to the wrong VC, like consumer hardware to enterprise software. So so complete the same exercise for acquisition in your space, so that you know who the acquirer are, and investor like to see that there is M&A activity within a space. So now I will be talking about preparing slide decks and executive summary. So prepare different slide decks of a variety of length to be ready for different kind of pitches. 2 minute elevator pitches, 5 minute elevator pitches, 15-minute pitches, 30-minute pitches. And then after that, prepare a summary paragraph about your startup company, and that can be included in email. Prepare a 1 to 2 page executive summary, and at last prepare the demo day presentation for large audience, more like TED Talk. And now setting up meeting with investors. So investors are often swamped with irrelevant or low equivalent page. So don't spam everyone you come across. You can reach out to someone who pitched your VC before. So you can reach out to someone, or you can attend some event, startup event in which at which VCs are speaking. So you can do that. And personal investor introduction helps to raise above the noise factor, and they will reply early if you are reaching out to VC via personal investor introduction. And leverage homophily and go for soft pitches early in your journey. So working on so and so, it would appreciate your feedback. So now I will be talking about what to be included in pitch deck. So we covered the core component of a startup pitch deck throughout this course. So first is, what problem are you solving? Your solution, that is the opening. And after that, opportunity. Show traction, demand, why now, what are the business model, how are you earning revenue, how are you making money to your business, SaaS, software as a service model, or any other business model, financial unit economic. You need to show them what is your MRR, monthly recurring revenue, and all that. And after that, market size. What is your total estimated market size as a TAM, SAM? You need to show this in pitch deck. And who is your competitor? Who and what is your USP? You need to show this. And after that, go to market and execution plan. And after vision, and at last you can include team slide at the last. So that's it. If anyone have any question.
Yeah, thanks a lot for that, Sahil. The language is quite interesting. I would like to allow the audience to hold so that because Jayren has to run off to another meeting, so we just want to get his insights, and then we'll get all the questions at the end of the session. So, and we'll probably stop the session at 11:15 just to manage time. So perhaps let me just allow those that have questions out of Sahil. So Sahil, maybe you can just share with us the Twitter so that we can get the questions to run through that also. So Theo, let me allow you to get running with your
Should I leave now?
Right. So you can see my slides, right?
No.
Can you see the slides? Okay, great. Yeah, it's showing. Okay, so yeah, sorry about that. Hi everyone, my name is Jayren from Gen Singapore. Thank you for inviting me to share more about venture capital. Sorry, I have to run in about another 13 minutes time. I'll quickly go through this, and of course, I can send this deck over, and the audience can also take a look at it subsequently, right? So I just want to briefly go through the VC outlook. I'll just start off with I'm based in Singapore, so I do just want to share a little bit of Singapore ecosystem. May not be the latest one because it's back in 2017. We do have an updated one, but yet to be announced. So you can see you have various VCs from different stages, early stage to late stage. If you can see here, early stage VCs. You have like Quest Ventures, Golden Gate Ventures, who invest around seed Series A, kind of deal. And then we have later stage ones. We have like Vertex Ventures, EDBI, which is the Singapore government investments, and we also have B Capital Group, which is Eduardo Saverin, the co-founder of Facebook, his own venture capital firm, also here in Singapore, right? We just want to share a little bit more. So Golden Gate Ventures recently released the Southeast Asia Exit Landscape Report 2.0, and you can see overall investment decline during COVID period globally, right? About negative 42% compared to pre-COVID. And then in Southeast Asia itself, you still see quite active investments, only a negative of some 15%. So Southeast Asia has been a good place for fundraising from VCs. Still a lot of opportunities in Southeast Asia. You can be a company incorporated elsewhere in Cayman, etc., and have operations here in Southeast Asia. In terms of deal flow by this region in Southeast Asia where I'm in, Singapore do have the highest in terms of deal activity, 42.6%. And roughly it's pretty much a hotspot for Southeast Asia, about $3.66 billion raised. And of course, a large portion of this goes to one of our unicorn, Grab. It's like a Uber in Southeast Asia. And they already a unicorn status, and now they also have a SPAC, which is a special acquisition company listed on the stock exchange, right? So M&A, merger acquisition, constantly drive in assets. We see about 45 deals so far. Of course, Singapore topped the chart. Average deal is about $74 million US. And I just want to quickly go into what smart money is. I think Sahil earlier on shared a lot about the difference between the kind of investors. You have your PE, you have your VCs, etc. So essentially, VCs are like a subset of PE, private equity. They raise money from LPs, limited partners, and then they do the investments on behalf of them. So essentially, they're like fund managers. But smart money, what really is that these investors don't just invest money or know how to invest money to generate returns for their LPs. But more importantly, they are also entrepreneurs themselves. So Quest Ventures, one of the early stage VC fund in Singapore, they focus a lot in Asian and Southeast Asian investments, and they believe that the best kind of investors are those who are entrepreneurs themselves. So many of the partners at Quest Ventures are all entrepreneurs themselves. right? Couple of portfolio companies they have invested in over the years. You have Shortbag, Carousel, Xfizz, Caro, etc. So these are a couple of better performing startups. And just yesterday, it was announced also Singapore car market, Caro actually becomes a unicorn. So congrats to Quest Ventures. They actually was one of the early investors in Caro. They raised $360 million US dollars from SoftBank Vision Fund 2. They of course achieved a unicorn status in 5 years. So the first auto marketplace in Southeast Asia, right? And this is roughly a basic sharing of how this process of VC investments works. So they do fundraising. So I mentioned the LPs, right? LPs can be individuals, high net worth, or it can be from family offices, can be from institutions coming together to put together a fund, right? And then you have a fund manager who is licensed by the central bank to allow them for the fund to be set up. There's many other structures available now. VCC structure is also very popular in Singapore, and that's that's probably one of the things. If you're looking at setting up a fund for Asia investments, I think Singapore will be a good place to do so. So investments, you have like due diligence setup. Usually analysts will go around getting deals, trying to curate the startups, do a due diligence process with them, and then if they found some of the startups good, they may bring them through incubation or their own. Do VCs nowadays do have their own sponsored accelerator programs or in-house programs to help get the startup ready for the investments. Of course, if they raise, they're part of the early round for VCs. They may exit after 1 or 2 rounds just to get some return. They may not fully exit. They may also do full-on investments, and subsequently the realized capital gains will then be distributed back to their LPs. Usually, of course, ideally would be like to 10x, but recent years I think you can see probably about between 4 to 5x. Venture capital, it's essentially exchange of company shares, your equity for that. There's also other things like I think Shahil also sharing about convertible note. So that also help because you do not value equity yet. Essentially is a loan where if the investors felt that okay, maybe this is a good startup, I would like to convert that into equity, and then your valuation will come later on. So that for early stage startups, I do recommend a safe convertible note. And typically, venture capital firms, I mentioned, from high net worth institutions as their LPs, and how VC works, they work a 2 and 20 fee structure. I'll share a little bit on. And of course, entrepreneurs do pitch to VCs because they are the one most hands-on to help the startups, right? Because the investors themselves may not have the time to, so they outsource that component to VCs who will be managing the fund to generate returns and sit there help the startups become successful. So what is the 2 and 20 fee structure? Essentially, the 2 refers to the flat rate. It's like a management fee, right? That from the total assets under management. So if let's say they raise 100 mil fund, in this case, or Quest Ventures, they raise 100 mil fund, and 2% of that goes to management fees for the VC firm itself. So regardless of the outcome, whether it's a successful returns or not, they still do get a 2% fee to pay for staff salaries, office expenses, any kind of operational expenses, right? Administration expenses, etc. And the other 20 represents a 20% carry. Essentially, the capital gains on assets over the period of time that the VCs is running the fund, usually about 10 years, right? So, based on the outcomes after 10 years, they get to keep 20% of the capital gains. Right? Depends on how you look at it. I think a couple investments in early stage companies, if you're thinking of setting up a fund, or if you're thinking of being an LP of a fund, and I think you have to also manage expectations. I mean, usually early stage companies, they compete with not much cash flow, they don't have a product, and to them some of the founders think their stocks are actually the most prized assets, but may or may not be the case, because if good case, in a best case scenario, you have a 10% stock of a $1 billion company, right? And that will worth a lot much, right? But if you have 10% of a $10,000 company, or maybe it even get a deficit, and you don't even get returns, you probably lose money from it. So it really depends. So I don't think that the stock really matters, but essentially entrepreneurs should focus on increasing, improving the revenues generated. Best is look at net profits over a period of time. Year on year, there's increase on that. Fundraising is not like a good thing. Or I mean, most entrepreneurs think it's good to show off that I raise lots of funds, but that's not actually business, right? So the real business is making the money, right? Making a buck. So don't look at successful fundraising as a good milestone to go for. Just look at building a company and then help it to scale and increase its valuation over time, increase its revenues generated over time. So VCs themselves, like I mentioned, so this is just a more visual, for you to see how VCs work. So the equity of startups, some of them do others services based, or you do have like Y Combinator, etc. It's like a hybrid of a VC and accelerator to do that. So they don't just provide the funding; they have a structured program to accelerate your growth. So look, be careful if you're an entrepreneur. See who are the VCs firm that you want to reach out to, and if you want to look up at a couple of let's say feedback, honest feedback from other founders who have raised VC funds before, you can check out vcguide.co. I think a couple of Silicon Valley startups, etc., also do comment. Like it's kind of a rating or review of VCs that they have fundraised for. Yeah. So do ask around, who are the best VCs in your region, and make sure the VCs are the one who can value add to your business, not just the money itself. So I mentioned, regardless of outcomes, they still make a 2% management fee, right? So exit, I think, typically is a merger or IPO. In Southeast Asia itself, we do see more merger happening compared to IPO. But I think like other parts of the world, especially in the US, IPO is definitely something that most startups will go for. So what essentially means is that you get an exit for the amount you've put in, right? So if you invested early days, let's say $100,000 for 10% equity, right? And then there's a valuation of $1 million, and then now you exit for say 10 million, right? So that 100K you invested in, that 10% equity is now worth $1 million, right? So you make 10x. So that's essentially how the VC's idea works. Is get in early. Of course, the risk escalates, right, when you get in too early, and you take higher risk when you are in early, so as well, right? Because entrepreneurs makes the difference. And sometimes market movements, like let's say you invest in a travel startup, now is probably a bad time. You may take a couple of more years, five over years, for them to get back to its original trajectory. But essentially, the VCs usually have funds within a 10-year cycle. So they do hope within 10 years they can find some exit, right? Rather than waiting for it to be acquired, they may choose to dilute their shares in the next round of fundraising. So this is an example of what an exit looks like. Funding rounds, if just for understanding, seed is now probably around 500K to even $1 million, so it could even be more. We do have companies who have seed round raised at 5 million. So we don't really know how to classify that now, because different stages, different kinds of companies, startups in different industries, they have different requirements of startup capital, right? So it's something that's more capital intensive, of course. 100,000, 500,000 don't help them much, right? They need at least $1 million to 5 million to get started, right? Those asset heavy ones that requires more capital to get started, right? And Series A, Series B, then IPO, right? So usually a Series B and above, you consider them as like growth stage. Generally is better, but I think we still lack a lot of early stage VCs because the risk is higher then. But that's also important, because if we don't have enough early stage VCs, then we would have startups who can get onto a Series B and above to really scale regionally or globally, right? So this is pretty much the check size for pre-seed to to Series A, Series B, Series C. So you can see the type of investors you'll probably look for. So if you're an entrepreneur and you're probably looking for a pre-seed round, I think you can just go to your friends, families, and fools, right? The three Fs who will probably be more willing to come and support your venture and help you get started, right? So angel investors, you can just reach out. If you're in Southeast Asia, the business angel networks, Southeast Asia, BANSI in short, do also actively invest in startups. Of course, subsequently, if you're raising mil to 3 mil, seed funding, you can look for early stage VC funds and then subsequently larger ones. Right. So I think it was already covered, but essentially some pointers to note. I think key thing is apart from the problem, solution, the team, I'll say this is one of the most important at early stage because your experience, your past experience, and what's your competitive advantage of your team would definitely help the VCs to have more faith in your startup and more willing to back your company and provide the funding than someone without that experience, especially a domain knowledge. So I think it's very important to identify why you, right? Why are you the best team? Why are you the best founder to be leading this startup to solve this global problem? And how do you plan to, do you have the expertise to take this to the next level, right? So at some point in time, startups to say, okay, maybe, the founder do not have the experience to take it to the next level. We may have to hire a professional CEO. So that's where the board members will then decide if they want to hire a professional CEO. In the case of Uber, for example. Yep. So you have a VC page structure. I think good thing is that the key thing is that VCs have so many pitch deck a day, about at least 80 to 100 pitch deck a day, and I think the key thing is to capture attention. The attention span is probably about the first 2 slides. They could probably make a judgment whether this is something they want to carry on. So I think good to really emphasize the why you're doing this, the vision, and what you're trying to solve, right? And then of course, most importantly, how does this startup of yours or idea of yours makes business sense, right? So just sharing, run Questions Ventures, we do kind of also venture building for startups. And we also run Entrepreneurship World Cup. It's the world's largest entrepreneurship competition globally, 200 countries, 175,000 startups across the world. And the grand final is held in Saudi Arabia annually. This picture itself is actually in 2019 when we could still travel. 2020 was virtual, and in 2021 it may also be virtual. But yeah, you can see we supported startups, and it's a Singapore startup who went on to represent Singapore on the global stage. And of course, they got good exposure, connections to take their startup to the next level, right? Other things we do also, we run programs, right? Involved in summer school programs if you need to build ecosystem. So ecosystem development is something I think you should look at when you reach out to VCs or potential investors, because the ecosystem effort to help you, either to get partners on board, to get potential customers on board, or even potential exit plan, right? So usually we see startups getting acquired earlier is because their customers did a calculation, right? For me to pay you for the next 5 years to use your product, I might as well acquire you and then have you to work for the company for maybe 1-2 years, right? As part of the exit, the merger or acquisition plan. Right, so usually you want to scale fast. You find venture capitalists or investors that has a good network to the ecosystem to help you to grow. Right, so boot camps, workshops, tours, go-to-market program, right, and of course ecosystem mapping. These are things, services that we also provide apart from just money. Clients for this, right? So if you have a feedback, do scan this and then provide us with feedback. And that's all for my presentation. Thank you. Right. So I think if there's any questions, you may, share it with the organizers, and I'll be happy to take the questions, answer them through email. Yes, and I'll also send a slide deck here to the organizers. All right. Thank you so much for having me. See you.
Thanks a lot, Jayren. He really has to run off because of time. We for those that are interested in that presentation, just reach out to us. We'll be happy to share the presentation with you. Larona, perhaps now to just bring it home, perhaps you just want to jump on and talk a bit about Accelerate and how this all links into the work that you guys are doing with Stanbic Bank Accelerate. So welcome, Mr. Larona.
Thank you very much, and thank you to your listeners. Thank you for inviting and having us on your platform. Can you hear me, just for confirmation? Can you hear me? Okay, brilliant. So I'll just talk through and thread it from where this discussion started. Also, in the interest of time, as you mentioned, we've lost a bit of traction. So, in essence, where we come in as Accelerate is that we have this platform which is all around stimulating innovation. And, the context that we have here at home speaks to also the need to develop the broader ecosystem to ensure that all of these steps that will take us to where we want to go find a base, and that base, entails working, with the different ecosystem players across the different sectors and industries, tech, agri, manufacturing, you name it. So our role, from Stanbic Accelerate speaks to the need to identify ecosystem players such as NGWANA Africa and others in the different spheres, as I have indicated, with whom we would join hands to unearth talent that exists in the country. I mean, for example, our footprint at this stage is based in Gaborone, that is Accelerate. So our brand extension or our execution extension relies in us being able to connect with those on the ground, as Mooketsi, you are saying, to bring it home, because working a tier below where we are allows us to be in a position to touch base with the very target client who you have a better understanding of. And through this, our model entails from the get-go, distilling, those ideas from being concepts to being most viable projects or products that can be placed or tested before they are placed in the marketplace. Then you move on from there to say, what specific interventions do each of these concepts require or need for it to become scalable? Then through this model, apply that intervention for scalability. And then you take that through to the next level of incubation, mentorship. And one of the key elements, once you have done all of that, is to ensure that you are able to take these products to market, the marketplace, because that is where they are mostly needed. How then and where do you pivot them in terms of? So there are a good number of initiatives that we are doing, also in partnership with different corporate partners. So from a Stanbic Bank side, we've recently launched a procurement system through which it's developmental in nature to ensure specialized procurement would target these startups and provide a development or nurturing path. So you're looking at capability, you're looking at quality, you're looking at development, broadly speaking, to say, so this is how we then want to make sure that we pipeline these into our own procurement, because it is from there that you are then in a position to give them the legs to stand on, such that another corporate, another establishment can also look at them and say, this is worth, taking a bet on and running with this entity. One of the key fundamentals that are indeed a challenge is that of funding. So through the same model, we look at how, chiefly, accelerate funding can be routed through our implementing partners to capacitate these businesses or these enterprises to tick all the requisite investable boxes. Because without that capacitation happening, it becomes very difficult for any of the financiers or investors to be able to look into how we can, project them for their future. There are other opportunities that maybe at this stage are slightly early to make mention of, but there is a new global market opportunity that we should launch very soon, and it's a cohort of various global multinationals who, under this platform, we would be able to train startups, and certify them for this market. So it's one of those initiatives that we should be launching within a matter of weeks. So from where we are, this is the role that we see ourselves playing in terms of giving capacity to startups and innovation. Mooketsi?
Yeah, Mr. Larona, I think it's interesting to know the work that Stanbic Bank is actually doing. As you mentioned, one thing I pick is that it has actually set up an accelerator or if an incubator in Gaborone specifically, with the aim to bring in those that are building, around digital startup in Botswana. And as you say, you have announced a call for partnerships for those that may want to onboard and to work with you. But I think for the purposes of time, perhaps you could share contacts of how they could reach out to you, because I didn't pick any questions. Just on that, so that we can jump on to the next session. I'm really sorry, guys, that I have to push because of time, that we have to really move quite faster than normally. So Larona, just maybe in terms of how do people actually reach you and collaborate? Maybe you could just give us that contact and that linkage.
Okay, so physically we are at, as you say, in Gaborone at Fairgrounds Mall, Unit G26, or they can reach us at 397-5075, or through the Stanbic Bank Facebook channel. That is where we also transmit a lot of communications. But most importantly, as I said, we want to be able to exist through where you as implementing partners are. So most importantly, anyone who gets hold of NGWANA Africa would be in a position to get a hold of Stanbic Bank Accelerate, and any other partner institution or prospective partner institution that wants to play the role similar to, i.e., what NGWANA Africa plays. The most important thing is for there to be alignment in and around ecosystem development, building, and capacitation of startups or entrepreneurs in general.
Yeah, colleagues, let me thank Stanbic Bank, who are our corporate sponsor for this event for the last 2 years. We would like to really appreciate their support, and we hope that the interest we have to actually build something around the energy business will also pull them through that particular project that we want to do. So let me now maybe request that you allow me to end the session here so that we can now get into the really important topic of the day, which is the actual energy opportunities of how to actually start an energy business and where the opportunity is in Botswana. So this session will feature the Solar Association of Botswana. It will also feature, entrepreneurs from South Africa who are actually in the business of solar. We've also invited the Office of the President, specifically the Poverty Eradication Office, who will speak about how to actually take solar into aquaculture, fish farming. We also have Navratan from India, who run the biggest, association that has been able to do startups around energy in India, and a lot of their models are in NEV for the work that we're doing. We also have Professor Rejoice Teko, who will speak about from Botswana University of Agriculture and Natural Resources. He will speak a bit about the work that they are doing around satellite and imagery with respect to solar and agriculture. So I think let me end the session and allow you to join me in the next session. Thank you very much for this.